through this? Okay. All right, so this slide is really just a summation of what we just did in terms of computing the payable. Okay, so I mean, this is really the end of the step 2 section. So think of preparing the tax return, identify perm versus temp, and at the bottom, and you will find that this is always frustrating, you know, when we start doing when we start doing problems that have a separate Fed and state rate, you can't forget to do that. Okay, and this, I would say that this, meaning the state and the Fed effective state, that plus stock compensation is easily the 2 hardest and most frustrating parts of the course. So the sooner you wrap your head around the Fed effective state, the better, because it will come up in many problems. It'll come up in the take-home exam, and you need to think, well, first I'll do my state provision, and then I will do my federal. Okay? Don't do both at the same time. Remember how I said jurisdiction by jurisdiction? Federal and state are different jurisdictions, right? Do your California provision first, do your step 1, 2, and 3, then go off and do your federal provision, step 1, 2, and 3, and add them together. Okay? Don't try to do it all at the same time. You will mess yourself up. Okay? That is my advice on that. Okay. Return to accrual adjustment. So we talked about this a fair amount with Tracy, and then also as we were going through the terminology. This is really the comparison. I mean, I think the second sub-bullet here kind of says it right, which is this is the comparison of each of the items that are in your prior provision to what goes on your final return. Okay? If you can get your head around, think of that last problem we just went through. What if I got every single number slightly wrong? My payable's wrong, my deferreds are wrong, my expense is wrong, my rate rec is wrong, everything needs to change, right? But the way I would fix it is I would just do it all again using the right numbers, and I would show the flux, right? How did my meals and entertainment change? How did my bad debt reserve change? It gets confusing when you look at a big company's return to provision, because they might have, 70 differences or something, and you're like, oh my gosh, this thing is a train wreck, right? But you just got to think individual item by item. What's the effect of payable? What's the effect of deferreds? And how much does the provision change? Okay. And as a practical matter, if I go to a client and say, oh gosh, it looks like we really booted the bad debt reserve at the provision, it was a lot higher than we thought it was, well, they're not going to care that much, because it just means that there's more of a DTA than I thought, more of a payable than I thought. But those are balance sheet accounts, right? And so if it's a temp item, it doesn't drive a provision effect in the same way that when we were doing last year's provision, it didn't drive a provision effect then either. Okay? So companies are not sensitive, typically, to return to provision adjustments that affect temps. But if you come to a CFO in Q3, like if Tracy goes to her boss and says, man, we really goofed some perm items in Q3 or with our return, we're going to have to take a charge to basically true up our provision from last year. Like, that's not good news. Probably nobody was expecting that. So then you have to explain, well, why is it so big? Why didn't you get it right before? How come I didn't know last quarter? I mean, all sorts of just questions come up, right? So unless you have good news, you will have questions to answer. And typically with provisions, if there's any uncertainty or volatility with the provision, that's not good news. So the focus is always on get the perms right at the provision, because you want your true up at the end to be nominal, right? That is the objective of just about every provision person. So Grant was asking about change in estimates versus errors, and we'll talk about that in a second. Okay, super simple return to provision adjustment. We thought penalties were $200 at the provision. It turned out they were really only $130. We thought meals and entertainment was $100 add back. It turned out it was only $70. So at our provision, we added back 300, right? But we should have only added back 200, and we did on our tax return. So that means that our provision, we over-accrued for the tax effect of 100, right? We thought we were going to owe more than we ended up owing. So to fix that, if you think step 1, step 2, step 3, step 1 is, well, we got to fix our payable. Our payable was too high, so I need to bring it down, right? I need to debit my payable to reduce it to what it really is. There are no deferreds because we're dealing with perm items at this point, so I have no step 2. So the effect is a provision adjustment. Okay, and in this case it's a credit, so that's a provision benefit, but it can go either way, right? It just depends on which side of the actual amount your estimate originally was. Okay, make sense?
Excuse me, so I'm a little bit lost now. For this item we're talking about is permanent item, right?
This is a permanent item.
Why we were also talking about is the accrual of the penalty and accrual of the so how it can be different? It is actually happening, and then when I book that, it is meals and entertainment. So I
right.
book that entertainment and meals as one item.
So let me use different words. Okay, so I think when I used the word accrue, that was causing you to think I was talking about temporary items, I think. So when we did our provision, right, this 300 we thought was a perm, and we basically said at provision time, debit expense, credit payable for 120. Okay, if that was the only thing we had, that would be the journal entry we booked last year at the provision. Because we would think we would owe 120 or 40% of that 300. There's no temps in this picture, so we would have that tax expense. And then we come along and we do our return and we say, oh, that wasn't right. If I could do this all over again, I would have debited an expense of 80 and credited payable of 80. Because I really only owed 40% of 200.
So does it mean they're doing their booking wrong?
Well, I don't know if you want to say wrong, but we estimated here based on the best we could estimate, and it turned out our estimate wasn't right, which I think is the same as wrong. And it's just a nicer way to say it. And so so in reality, again, if I could do it all over again, I would have booked that entry, that 80. But I can't do it over again. I already booked my 2011. I released my financial statements. What's done is done. All I can do now is fix it. Okay? So this is my subsequent incremental entry that I need to book. Okay? And that is what we're going to do.
That goes in the current period?
It goes in the period where you figured it out. If that's when you figured it out. Yeah. Okay. So
I guess that means you could really manipulate your income for the current year if you do it in the following year. You'd make adjustments in the following year instead of the following quarter. If you're intentional about this, you understand what I'm saying?
I do.
Purpose.
Yeah, really, no large public company is moving return to provision adjustments around to manipulate the rate, because if it's big enough to make a difference, it's probably a problem for SOX control issues. So you're stepping in your own mess a little bit if you're trying to create return to provision adjustments.
There's other ways to manipulate.
Yeah, exactly.
Andrew controller does.
That's a different class. Yeah, that's not this class.
It's a revival of us.
Okay, so this slide is the same concept, but with temporary differences. Okay, so just like we estimated incorrectly for permanent differences, we can estimate incorrectly for temps, right? So, simple example, bad debt reserves. We thought our add back was going to be 50, right? And it turned out our add back was actually 80. Okay? So that's going to make our payable go up, right? We're going to owe more tax because we have to add back more than we originally thought. So that's a credit. We need to book a credit. So that's step one. Step two, did our deferreds change? Well, yes. We had a DTA. That's going to go up. So that debit will change. Okay? So if your credit goes up by 40% of that 30 difference, and your debit and your DTA goes up by 40% of that 30 difference, then you have a balance sheet entry where there is no provision effect. Right? So we're simply correcting our payable, and then we're correcting our deferred, but because it's a temp item, it doesn't drive a provision effect on a net basis. So all this example does is it takes that bad debt reserve example and it adds 4 facts together and takes that 350 difference by 35% and says, well, gosh, on an actual basis, I would actually save 140 of tax, but in the future, I'm going to owe 140. So I need to book DTLs, right? I got my DTLs here, and I'm going to correct my current year payable. This current expense and that deferred expense, those wash. So that current deferred really only matters from a disclosure perspective, but on a net provision and an ETR basis, it does not matter. Okay, so think step 1, 2, and 3. Does it change my payable? Yes. Does it change my deferred? Yes, by the exact opposite amount. So therefore, does it impact the provision? No. Cool? Yeah. I wouldn't sweat return to accrual stuff, honestly. So of all the things I would worry about if I was you, I would not worry about this. David.
Why don't they net DTLs and DTAs? I mean, it seems like because it's all tax liability, you would think it would be simple.
Class 4.
Okay.
Yeah, stay tuned. Okay, so this is a slide on change in estimate versus error. You know, this matters more to the Tracys of the world than it does to you who's trying to learn provisions. So the content's in here. I'm not going to cover it. Okay. Okay, so then step 4, analyzing deferreds. Okay, so let's take a short break, and then we have an hour and a half left. And so take like 10 minutes, and then we'll come back and we'll crank through deferreds. Okay, and we're going to do another problem. Good? Okay, step 4, deferred taxes. Okay, so life will start getting more complicated, okay, because the more we deal with deferreds, the trickier things get. From a terminology perspective, I want to make sure we're clear and about the use of different terms. When I say a temporary difference, that should, in your mind, you should be thinking, okay, that's a pre-tax number. So in our bad debt reserve example from the first problem, that's the $7,000 that we added back for tax and we'll deduct later. That's a deductible temporary difference because in the future that'll give rise to a deduction. If you have a temporary difference, the tax effect of that will be a DTA or DTL depending upon whether it's a future tax saving item or a future tax liability. Okay? So temporary difference, pre-tax, DTA, DTL, tax affected. Okay? I think we've been through the definitions enough here to not go through the bullets. Okay, what I said in the first class was several times, and maybe in the videos too, think what would happen if you sold your balance sheet for cash. Would you cause yourself to recognize tax gains or tax losses? Okay? So if you sell your receivables for cash, you should have a tax loss because that book reserve is going to basically give rise to a tax loss you have higher basis in your receivables. Okay? Depreciation can work either way, right? If you have a different book and tax basis in an asset, when you sell it, you either have more tax gain or more tax loss. So figure out what would happen if you sold your balance sheet for cash. That will clue you into your deferreds. Okay? So you can see in that second bullet, DTAs represent the best estimate of what you'll realize in cash for an asset. And we're not going to go through it today in a lot of detail, but this slide does, talk about the general concept of a valuation allowance, right? If you have an asset, that just doesn't mean that it's a good asset. So another step is figuring out whether that asset should be haircutted before you put it on the balance sheet. Okay, that's class 3. That's next week. Okay, assets, future deduction, right? Liabilities, future income. The more you practice and looking at differences, like when you read the Cadence 10K, look at their deferreds. Why are they assets? Why are they liabilities? Try to apply the concepts to as many fact patterns as you can in real life, and that'll get you more familiar with what's what. Okay? So when you would have read this in your homework reading, but there's 5 steps to determining deferred taxes. I don't really know anyone who thinks of it this way in practice, but this is what the literature says. Okay? So, step 1, right? You identify the types of temporary differences, and notice that this is, on a pre-tax basis. Okay? So types and amount of temporary differences. So bad debt reserve, inventory reserve, depreciation, that sort of thing. Okay? Then you figure out your DTLs using the applicable tax rate. Right? So if I have something that's a taxable temporary difference, it's going to give rise to income in the future. I tax affect it and figure out my DTL. How much tax is this going to cost me in the future? Okay? Do the same thing for DTAs. Use the applicable tax rate. Okay? The applicable tax rate is whatever the enacted rate is, and if it's a rate that's moving around, like sometimes rates are like lowering on a year-by-year basis. I mean, not in the U.S., but in Europe that's been common, in Asia too. You'd want to forecast at what rate the deferred would turn at, but it would always be on enacted law. Okay, so you figured out what your pre-tax temps are. You've calculated your DTLs, calculated your DTAs. Now you do your DTA for credits. Okay, and the credits is separately, right, because this is a pre-tax item here, whereas the credits are always tax affected. But step C and D are no different. It's the same step. It's just pre-tax and taxable items dealt with individually. And then step 5, you reduce your DTAs by VA if that makes sense. Right? And we'll talk all about that next class. Okay? So that is the steps to coming up with your deferreds. Identify your temps. That's kind of the hardest part. Figure out what your population of temp differences is. Tax affect them. Figure out if you need a valuation allowance. Okay? Those are the 5 steps. I think sometimes you read that when you're just kind of going through the AAC 740 and you're like, this feels so like unhelpful in terms of exactly what do I really do. But that's how the guidance works, right? Okay, I feel like this slide says exactly the same thing we've been talking about in different words, so I'm not going to cover it. Okay, so as a practical matter, it says there's two ways that people think about how to capture their deferred taxes. One is a roll forward. Okay, and so this would be, all right, I had an add back of bad debt reserves of 7 this year, so now my deferred is 7. Next year I have a deduction for bad debt reserves of 2, so now my cumulative difference should be 5. Right? Next year I have an add back of 6, so my cumulative difference should be 11. Right? So if you're using a roll forward approach, you should be able to capture whatever your deferred is by just taking your cumulative prior temporary differences and adding on the current year. Okay? If you have done math correctly, you will get to the same answer as comparing your tax basis balance sheet. All right, if you just sit there and compare what's my tax basis in the receivable to my book basis, you should get to the exact same place. Sometimes you don't, and usually you don't because the company's records are a mess. I mean, that is the practical answer. And so when you've been rolling forward something and rolling forward, and then somebody, leaves the company and a new person, starts, and then I show up and start helping you, and I started asking questions like, what is that? How did you get that number? And inevitably people will say, that's been rolling forward for years, right? And then somebody defensive will say, well, we've always done it that way. I'm like, it's like when you get a speeding ticket, it's like, I always drive 80, That doesn't work, and it won't work with your financial statement auditor either, right? So most companies do use a roll forward approach, but they combine it with this balance sheet, and they say, like when Tracy will do her return to provision, she'll say, okay, what did I think my deferred was for a bad debt reserve? She'll say, last year I thought it was, at 1211, I thought it was 100, but there was a return to provision difference of 5, let's say, that increased it by 5. So I'd expect it to be 105. You better be able to go to your balance sheet and see that the reserve for books is also 105. Because if the reserve is, say, 112 on the balance sheet, and you haven't deducted any of the reserve because you wait until the receivables are written off, well, how can this be right? This is your basis difference has got to be the number you're keying off of. So most people use this approach, this roll forward approach, but then they check it with, did I get to the right answer? Okay? That is the common. And you will see, as we get into harder provisions, you'll see what I mean by this roll forward. I'll show you template examples of people's schedules, and they all kind of look the same, where they take the beginning of the year, they do a return to provision, they do like an adjusted deferred, current year activity, end of year, and they'll kind of have a little table that just takes all their deferreds, like deferred number 1, deferred number 2, and it'll just roll them across, and it'll show the activity. Everyone has their own little version of that. Some are easier or harder to follow, but we'll build something out like that as we go, but don't worry about it for tonight. Okay? I think that's all I want to talk about on deferreds, honestly. Okay, common examples of deferred taxes. So DTAs, anything that ends with reserve is usually a DTA. Or accrued something, that's usually going to be a DTA. Things that are going to give rise to future tax savings. I suppose the only thing that's even remotely controversial in this section is we talk about common DTLs being, oops, I don't even know how I did that. We talk about common DTLs being depreciation and property, plant, and equipment here. And that could go either way. I think the reason it's a common DTL is basically bonus depreciation, right? So for the last, what seems like about a decade now, companies are able to expense a big part of their fixed assets when they buy them for tax purposes. So that makes tax basis go way down, right? But book basis is still up there. So if book basis is higher than tax basis, that'll be a DTL. That's why a lot of companies have DTLs for fixed assets as bonus.
Not kind of a bonus, but how common is it for companies to use different methods for book and tax basis? Straight line for one.
Yeah, so Brian's question was, how often do people use different methods? I've never seen anyone use the same. They're always different.
Because of why?
Well, just because books will use a useful life, and they'll usually straight line it, and tax will use a tax life, just determined by tax law, and they'll use makers or, yeah, something like that. Right. Okay, so as we've already talked about, once you figure out what your temporary differences are, you'll compute what your deferred tax assets and liabilities are. And at the end of the year, you know, you got to think about getting your balance sheet right. At the end of the year, in this example, you should have these balances on your books. So we often talk in our examples about how to get to the end of the year balance through current year activity. But you, as a reality check, ought to stop and say, at the end of the year, did I get my deferred balance correct? Right? So think of that schedule that, I'm going to flip way forward here. Think of this schedule, okay? When you roll forward this schedule, you're going to get to a balance in your deferred taxes at the end of the year. You know, you're going to do all your journal entries for the year's activity, but somehow that's going to give you this ending balance. You need to prove that by looking at all your temps, tax affecting them, and say, yeah, all my temps actually do add up to what my ending balance shows. You can't just roll forward a number based on a bunch of journal entries and be like, I don't know, it just ends up with some number, right? That number on the balance sheet, that ties to something, and that represents your cumulative deferreds, okay? So it's great that you think of each entry as some activity that you do in a balanced sort of way, but when you get to the end of the day, you ought to be able to prove this deferred, and you ought to be able to prove how much you owe in tax, right? The balance sheet amounts should not be just amounts that are rolled forward, but they should get you to a destination that actually makes sense, okay? That's key.
Do you just adjust at the end to adjust it to what all the pieces, or do you actually go back and see what the balance was with that particular items? I mean, I would think you would do the former, not the latter, adjust it.
Well, you will always book what you think is the best answer as part of your provision, and then you'll fix it later to the extent you estimated wrong. I mean, that's where the return to accrual provision process will come in. Okay, so deferred tax assets and liabilities. Identify all the temps. Tax affect them to get DTAs and DTLs. Think about evaluation allowance, but again, that's class 3. Okay. I know I went through that really fast, but I want to spend time on the problem. That's why. So, are we confused at all at what a deferred is? Does anyone want to talk about DTAs versus DTLs? I suspect your challenge will be baking that into an actual provision and not so much hearing the concepts. So, we will do a problem. Okay, so the second example or in-class exercise that was in the email that was sent out is a list of deferreds, and the question is, how do you compute deferred tax expense for 2011? Okay. So think about how the deferreds changed and what the journal entry is that would come off of having those deferreds. Okay? So think, is it DTA, DTL, how is it changing? Come up with a journal entry that basically explains the movement in those deferreds. And then to make it maybe more real, assume a company had like 100,000 of book income, pre-tax book income, and use these facts to calculate the provision. Okay? You can do the whole provision, current, deferred, rate rec, effective rate, do the whole thing. Okay? So work together in your groups. Don't do this solo. You know, help somebody else or have them help you, and we'll pick it up in like 10 minutes. Okay? Okay, so let's go through exercise 2. Okay, and so the assumption was that, well, you have the problem in front of you. So what I'm going to do is do the solution just kind of freehand, and then we'll talk about how to make sense of it all. Okay, this will be a true test of handwriting here. Okay, so let's start with step 1, which will be our current provision. Okay. Okay, so if I'm doing my current provision, I said that I'm going to start with 100,000 of PBT. One of you guys want to explain this, by the way? I told I'd pick on you. Okay, I'll take that as a no. So I would start with my 100,000 of income, and I would add back 1,500 for my legal reserve. I would deduct 13,000 for the increase in prepaid insurance. I would use my NOL of 2,000. So that should get me to income of 86,500. Okay, 86,500 times 34% is some number. Sorry, what is it, Caitlin? 29,410. Okay, 29,410. And then I would use my credits of 1,200. And so that would give me 28,210. Right? So for step 1, I'm going to credit my payable for 28.2, and I'm going to debit my expense for 28.2. Okay? That is doing the current provision, right? We ought to be getting good at that. Okay?
Question?
Yep.
I guess I was wrong. I thought a carry forward would be DTAs.
A carry forward, you'll see that in just 1 second. So when we get to our deferreds. So at this point, we're saying all we've calculated is the current liability. It's as if we're going to file a tax return. We would owe 28,210. Okay, that's all we need to take away from step 1. All right. All right. So now we go on to step 2, and let's talk about doing a deferred roll forward. Okay. So the way I was trying to explain it to 1 or 2 of you was I would take my beginning of the year balance, I would figure out what my change is, and compute what my end of the year balance. So I have deferreds for legal, prepaid, and NOLs, and then I have I'm going to put in a little subtotal for my pre-tax. Okay, so at the beginning of the year, right, 12/31/10, I had legal reserves of 1,500, which meant in the future I'm going to save tax because I'm going to get a deduction for that 1,500. So that is a deductible temporary difference. It's a future deduction. Okay. At the beginning of the year, I had prepaid insurance that I had already deducted for tax, and so it was a taxable temporary difference because in the future there would be book expense, but there would be no tax deduction. I had a $2,000 NOL carry forward, which meant in aggregate I had 1,500 of temporary deductible differences. I have a 34% tax rate, so 34% times 1,500 has got to be what, 515? 5 what? 20? 510? 510. I have credits of 1,200, meaning Credits carrying forward will save me tax, so those are DTAs. So at the end of last year or the beginning of this year, I had $1,710 of DTAs net. Okay? So if I'm starting 2011, I'm starting with 1,710 of assets on my balance sheet because these represent future tax savings when I've added it all together. Okay? So now I'm going to figure out, well, how did these things change throughout the year? Well, my legal reserve went up by $1,500, so it is $3,000 at the end of the year. All right, my deferreds are growing. My prepaid went up to $15,000, and that's why in my current calc I had an extra deduction for $13,000. I used my NOLs, right? So the DTA, or the deductible temp difference I thought I had at the beginning of the year, that's toast, right? I've used it. So at the end of the year I have nothing. So at the end of the year I have taxable temporary differences of $12,000, which meant that my change was $13,500, right? And this should all match. Oops. This should all match step 1. Right? So whatever you're changing your deferreds for, there's an equal and opposite difference on the step 1 current calc. Okay, so none of these numbers should seem mysterious. So at the end of the year I have deferreds of a taxable difference of $12,000, taxable temporary difference of $12,000, and at 34%, that's going to be 4080. Did I do that right? Okay. 4080. Which means that we moved by 4590. So my credits got used. So I'm going to say that those went away. I have no more credits at the end of the year. So that means at the end of the year, I have a DTL of 4080. And during the course of the year, my deferreds change by 5790. Okay? So it's starting to get to be like a lot of numbers, right? There's a lot going on this page. But if this gets overwhelming, you could just do it one item at a time, right? How did legal reserve change your provision, right? Step 1, step 2, step 3. So I'm showing you how to do it all in aggregate, but I completely realize you might be looking at this page going like, I'm lost. Okay? So if I was going to book an entry from this, I would say that my deferreds need to be, my deferred taxes need to be credited by 5790, and my deferred expense should be debited by 5790. Okay? And again, that, I know there's a lot going on there, but your deferred expense is just your change in deferred. Okay? But if you think, well, you know, is that 1,500, is that in my current? 13,000, 2,000, 1,200? All those numbers should appear on our current calc going the opposite way. Right? And this is our current calc again. And there they are, just hitting the current going the opposite direction. So one side affects payable, one side of our journal entry, the other side affects the deferreds. Okay? It just looks more overwhelming when you see it kind of with things pulled together. Okay, so I would book that entry, that debit expense to $57.90 and credit DTL. And now at the end of the year, I can explain these as my ending deferreds. Okay? So I need to prove that what I get to at the end of the year of 4080, since I started with this, I booked an entry of this, I need to prove that this 4080 actually makes sense. And I can make sense of it by going line by line and saying, can I prove all these numbers? And I should be able to prove them. Great.
Would you, in a sense, credit deferred tax asset 1710 and then deferred tax liability 4080? Break it up that way, or would you actually book it all together?
Class 4. That's class 4. For now, just think of deferred taxes as deferred taxes. We'll deal with current, non-current, AAL. We'll deal with all that later. In general, you net, but that's an oversimplification. So you're right. You wouldn't end up with a big credit to DTL and leave the debit hanging. You'd normally net it all down. That's not always the case. Okay, so now I have my step 1, which didn't look too difficult. And then I have step 2, which starts to look kind of nutty, right? And so the provision ought to fall out from that. Okay? So I said that my provision, my current provision, was 28,210, right? And my deferred provision was 5790. Okay, so my total provision is 34,000. Okay, so what's my effective rate? Somebody said the word 6, I think. Should be 34%, right? Okay, and our statutory rate was 34%. So if we were doing our rate reconciliation, we would say, well, gosh, I started with 100,000 and I expected a provision at 34%, which would have been 34,000, and I ended up with a provision of 34,000. So there is nothing to reconcile, right? And that's because everything in our calculation was temporary. So everything we did had one effect to the payable and an opposite effect to the deferred. And the only thing we did different in this problem than we did in the first problem was we added beginning balances. And then we required ourselves to basically roll that forward, right? Before, we were just starting as if there was 0 and we were just booking the activity. But now we're just starting someplace and rolling it forward. That's the only difference. Okay? But you can see, just by adding a few more numbers on the page, how it becomes like exponentially more confusing. Okay? So what I would encourage you to do, as we just make problems slightly harder like that, is just go piece by piece, right? Like if that was hard for you, then I would say, okay, don't do all the facts. Just do the legal reserve. Assume there's 100,000 of book income and just make legal reserve work, right? And then add the prepaid, and then add the NOLs, add the credits. Do the journal entries one at a time to make it work. Because when you add it all together, like this page, I totally understand it. It looks intimidating. So don't do it that way if it's not comfortable for you. Okay? If you wanted, you could go back to this format and create journal entries for every one of those activities, right? But let's see if I can get the eraser thing to work here. So what you ought to be able to do is you ought to be able to book a journal entry so that you end up with 28,210 in your payable, right? We started with 0, and you ought to be able to tell the story of how we get from that to 28,210. And then we started here with 1710 of an asset, and we went to 5790 of a liability, right? And we want to prove that number's right, and that number's right. And if we do every row in an entry that balances, the expense that will fall out, the 34,000, it will work perfect. Okay? But I guess what I want you to understand is that there will be times when we start with a balance, and then by virtue of calculating our entries, it will get us to a new balance. And that new balance will be our ending balance. And then next year we will do it all again. We will start with last year's balance and we'll get to this year's balance. Mike?
Shouldn't it be 4080?
Oh, you're right. Sorry. Yeah, the change is 5790. Yeah, no, that's a good catch. See, I told you I'd mess things up. You just need to pay attention. Yeah, exactly. Okay. So if you got the first problem in class and you got this problem, you're doing great. If you got the first problem and you're totally struggling with this problem, you're like normal. Yeah? So don't worry. If you're like Timmy and you haven't seen the tracks yet, you know. He smiles a lot, so that gets you places too. You know, people like that. Gamma.
Under the payable column, are those figures supposed to be negative, or can they also be positive?
In our example, the 28,210 is a credit,
Okay.
but it could be anything, right? I mean, you could lose money and have the ability to carry that back and get a refund, so you could end up with a debit.
In that column.
Yeah, sure. You can end up with a receivable here. Not in our fact pattern, but in a fact pattern. Yeah. Okay. So you can do this many different ways, right? You can do it all together. You can do the whole step 1, like I did on that one slide. Do the whole step 2, and then pull it together and do a rate rec. But that is probably the hardest way to do it. So if you're struggling at all, breaking it down into the individual items, that is the slower but probably more safe or safer way of getting to the right answer, is my guess. Okay? Okay. So, assuming that the recording worked, then you can watch that again if you want. And I guess through the miracle of YouTube, you can just scroll right to wherever the time is and watch just that section as opposed to the whole thing. Somebody taught me the whole, you can just scroll and then it'll buffer to where you get to, and I thought that's how basic I am with YouTube. I didn't realize you could do that. Okay, so it's 9:37, and at this point, I want to walk you through what we're going to do for next class. And so you can see the reading assignment. Please do the reading. Next week's class, we're going to talk about cadence. And cadence will not be here, but I will be, and I know all about them. So you'll ask me questions, okay? And I'll ask you questions. That's even better, right? So they have a lot of interesting stuff going on, and you know the topics we're going to cover in next class will be unrecognized tax benefits, meaning tax exposures, and valuation allowances. Okay, they have both. So when you read their financials, I want you to focus on both. Like, learn as much as you can about the valuation allowance. Like, why do they have it? How long have they have it? Are they going to get rid of it? Is it, huge? Is it small? Figure out all the answers to those questions. And then on their reserves, do they have big reserves, small reserves? Are they setting up reserves, releasing reserves? What do they say about the reserves? If you were Amanda, what would you think when you read that? Think those questions. Okay, so since we're covering valuation allowance one of your homework assignments will be to find the world's largest valuation allowance. I mentioned that in class 1. If you know the answer, don't blurt it out. Let everyone go figure it out for themselves. It's not cadence. Give you a hint. It's funny. Some people will bring companies into class and they'll be like, "I think this one is huge." And I'm all, "That was not even big." You'll see. This one, the world's biggest, is big. Anna is going to send you out more problems. So if you like the 2 problems we went over in class, you were going to love the homework. Okay? So it is totally fine if you want to call somebody in class and work together. I don't care at all about that. This is not like I'm grading it. And I totally get that if you get stuck doing a provision, it's super frustrating if you're by yourself, and it's hard to kind of get yourself out of the funk. When I do provision work, it's almost never by myself. I mean, today I sat at Yahoo most of the day, and it was with 2 other guys, and we just sat there and we figured stuff out, and we did it together. So it works for me, it can work for you. Okay? There's no shame in saying, I don't get it. Let's kind of figure this out together. Okay? All right, and then the case study. So at the back of your deck, we have included, you can see this deck is 80 pages long, but at this point we're only on slide 52. So there is a case study that is going to run through tonight, next class, and the following class. And we're going to kind of hit in steps. Okay? So I'm not going to go through it now because I kind of like you to think about it on your own. But the facts are laid out in detail. Okay? So we lay out this company. We give you some information about their financial statements. Here's their balance sheet, for example. Here's a whole bunch of facts about things that are happening, their NOLs, tax rates, right? So all sorts of facts. And then I want you to think in the form of those 10 steps, right, that we're going through. So like 1 and 2. Step 1, identify perms and temps, right? Step 2, compute your current payable or receivable. Step 3 is going to be do your return to accrual. Step 4 will be deferreds. We will stop there because that's all we've done, right? We've done steps 1 through 4 in class, so you're going to do steps 1 through 4 in the case study. And then either I will send you a video of me going through the answer, or we'll go through it together in the beginning of the next class. It's really just a question of how I think we'll best use time. Okay? I'm not going to send you the answer to this one until probably right before class, though. So if you're one of those types that does your homework like Tuesday morning before class, you're probably not going to get your biggest bang for your buck out of it. Because I'll send the solution ahead of time a little bit, so those of you who like studying and processing it at your own speed can look and digest it. But I'm going to try to leave enough time for you guys to struggle through it too. Okay? Because the learning is in the struggle. Okay, so that is class for tonight.
So before you leave, how do you find them?